Good morning. For Traders Exclusive, this is George Tkaczuk, we're RCM Wealth Advisors, reporting to you from the CME Group trading floor in Chicago. What I'd like to do is take a look at the equity markets this morning. So the equity markets lately have been sending us mixed signals, meaning growth stocks have pretty much imploded, have been pretty much destroyed. A lot of the widely held names were building the right side of their basis, and that's coming a little bit into question. However, the positive things are that Microsoft's keeping its $1 trillion valuation, and Apple's also trying to break into that $1 trillion mode. So that's a positive. Those things are positive things indicating that there is still some demand for shares. However, the S&P once again is failing at that 3,000 level. Nasdaq's having trouble holding on to the 8,000 level. But there are a few very positive things going on underneath the market. Market breadth continues to be very healthy. If we look at the NYSE advanced decline line, or if we look at the number of new highs minus new lows, whether it be in the Nasdaq or the NYSE, those are all leading the market, and that's a very positive divergence. Furthermore, we have pretty much a volatility contraction going on in the indexes, and I'll explain that right away what I'm talking about. And that's a very positive sign. That's the kind of sign we see before markets explode to the upside. So, no guarantee, but it's an interesting pattern. So for instance, if we take a look at the market correction between last October and December, Nasdaq corrected about 25% from high to low. S&P corrected about 20% during that time period. Then the market rallied and we had another little correction in May, and whereas the Nasdaq corrected about 11%, the S&P corrected about 8%. Then in August we had another little correction where the Nasdaq, I believe, corrected at about 7% or so, and same with the S&P, right about 7%. So these corrections are getting shorter and shorter. And now in this September, the markets have pulled off again, but the volatility is out of the market, meaning the S&P is off about 3% from its highs, and Nasdaq's off about 4% from its highs. So you take a look at all those little bases, they're getting shorter and shorter, and that tells you that the market may be building some steam, coiling up. There's a lot of cash on the sidelines. People are very nervous, high cash positions out of funds. Most market participants are kind of very pessimistic, so that's a great contrarian indicator. So this is just something to look out for. It's no guarantee. As always, I said, let price and volume be your guide, but watch those indexes, and if they do break out to the upside to new highs, be ready to look at some growth names that are leading the market and see if these things go higher. So as always, let price and volume be your guide. This is George Tkaczuk, our RCM Wealth Advisors, reporting to you from the CME Group trading floor in Chicago. Have a great trading week.